Josh Whelan here at Alterra Advisors. As many of you, I'm sure, have noticed, tariffs, market volatility, lots of headlines going on, and lots of impact to folks' portfolios. And so, what we wanted to do was bring in Russ Martin, Senior Portfolio Manager here at City National Rochdale, to share some perspective, walk through some of the analysis you guys are doing. Your team is really thorough about all this stuff. So, we'll talk about what you guys are seeing. You'll bring us up to speed on what's happening on kind of the tariff front, how you see that impacting major themes for 2025, and then wrapping that up with what do you think investors ought to be doing, thinking about during a time like this. So first off, Russ, I know you have a lot going on, so thank you for taking the time to join us here. Maybe take a minute to introduce yourself.
Yeah, thanks, Josh. Appreciate you having me, and thanks everybody for taking the time to listen in. I am Russ Martin. Been here with City National Rockdale coming up on 11 years as a client portfolio manager, and I work with independent advisors in managing custom portfolios for clients, a big part of which is navigating through volatile periods like this and making sure that folks are still aligned with achieving their goals and objectives and that they're up to speed on how we're assessing the situation and any necessary changes or adjustments that need to be made or not during periods like this.
Well, so you guys, as you kind of go through forecasting and evaluating the economy, portfolio strategies, investment strategies, and so on, you do a good job putting themes together that you're paying attention to. A couple that you guys had here at the start of the year: labor, inflation, tariffs have been in the headlines for a couple of months, and then obviously accelerated recently. And then what the Federal Reserve's response is likely to be. So maybe just bring us up to speed. Where are we? Where are we right now?
Yeah, at the end of the day, the forecasts that we have for the economy are really all centered around what's going to impact the flow of money. And a few of these categories on the page here obviously are top of mind as far as what impacts there may be. The tariff discussion is front and center right now, given some of the major changes to trade policy that we've seen and just how quickly those things are moving. But what we're assessing here is how might that impact the labor market and companies' appetite to continue hiring people. We got a great jobs number last month, 228,000 jobs added in March. And to maintain that employment, because at the end of the day, we need people to be spending money to drive the main engine of the US economy here, which is consumer spending. But the changes in trade policy also may have an impact on that spending by way of inflation and what impact it may have on prices of things and consumers' tolerance for continuing to pay for them. Finally, depending on what happens with consumer behavior and the overall economic engine, that's going to maybe impact what the Federal Reserve does with interest rates. Those things, however, are still downstream of how the tariff policy plays out. And right now, that really does seem to be centered on the escalating tensions with China.
Yeah, and so you'd sent me some really helpful analysis that you guys have done, including kind of this slide that captures that. So you just made an important comment. The tariff policy, as we know, has changed pretty dramatically. It's been proposed and then paused and then proposed and escalated and then paused and revised again. Where are we right now? Explain maybe why does it seem so clear that the focus has narrowed in on China for now, and then what impact might that have from a market and economic perspective?
Sure. Well, after an initial escalation of tariffs across the board with all countries, we've most recently seen a return for all countries to that baseline of 10% tariffs, with an escalation specifically to the tariffs that are placed on imports from China. It's important to evaluate where we import items from around the world. And for context, looking at how imports are relative to the size of our overall economy. So the chart on the left-hand side of the page is looking at imports and exports, and it's looking at them as a share of our total imports and exports for our three largest trading partners. So you'll see
So
Mexico.
to kind of contextualize that a little bit, what you said is at the start we've the tariff policy was going to impact kind of countries across the board, many different countries around the world, including some of our biggest trade partners, Canada, China, Mexico, and then with the recent changes, pausing on Mexico, pausing on Canada, but retaining the tariffs on China. Is that what I'm understanding here?
Well, I haven't checked social media in the last 8 minutes,
Sure.
Josh, but
Yeah.
yes,
Fair enough.
as of the most recent reading, that's absolutely where we're seeing the escalation occur. So we've got a
Gotcha.
90-day pause on the much higher tariff levels with all countries other than China. There is still that baseline 10% level across the board that retains in place, but the focus is on the dramatic escalation to tariff levels with China.
I see.
So that, from a tariff perspective, is where the near-term focus is going to be. But the chart on the left there focuses on who are our biggest trading partners. And those three countries, by far and away, as you can see, make up about 40% of our total imports and exports. Mexico, China, and Canada.
So this tells
Now,
me that based on the last 12 months from January 2025, uh, China was responsible for about 13.2% of imports and 6.8% of our exports. So they consume
you got it.
6.8% of our goods, and we consume of total share. 13.2% of our consumption comes from China.
That's exactly right. Yeah. And I think this is a good time to remember imports overall as a percentage of the US economy. It's actually much smaller than some might think. Total imports are only about 11% of the US economy. Our GDP is about $29 trillion, dollars, and we import about $3.3 trillion dollars from overseas. And as you pointed out, about 13% of those imports come from China. So for those math geeks out there who are keeping up with where I'm going, when we take 13% of the 11% that imports are of the total economy, imports from China make up only about 1.5% of the total size of the US economy, just looking at a dollar perspective.
I
Now,
see.
that's not to say it doesn't matter. It most certainly does, but it helps us to contextualize the headlines and the things that we're hearing with respect to the magnitude on the overall economy. Now, the chart on the right is also interesting for some historical perspective because the red line is showing us the percentage imports from these countries, and the red line specifically is China, over the past decade. And what you'll notice is that after the tariffs that were put in place during President Trump's first term in 2018, you started to see that red line, or the percentage of our imports from China, falling. Now, there was some volatility there immediately after COVID, but the trend has continued such that there has been, over the last 7, 8 years, a substantial decline in the percentage of the total imports into the United States that come from China. And a lot of that has been companies diversifying their supply chain to other Southeast Asian countries, or even to places like Mexico, where you can see in recent years that light blue line has ticked up. So definitely a change in the overall balance of the trade environment, and specifically where we're getting our imports from here in the United States.
Well, so that'll help us maybe contextualize then. You guys do a good amount of forecasting, which is helpful for then framing your perspective. Things like GDP, essentially the production of our economy, corporate profit growth, how much will companies grow, how much they're able to make, inflation, and then what we expect from interest rates from the Federal Reserve. So maybe you could focus in on with what you guys are observing related to tariff policy. What's your current thinking on how that will impact your forecasts for the year?
Yeah, so again, with everything moving so quickly, the thing that I'll highlight up front is that the severity of the impact, the headwind here to overall economic growth and profitability, is very much going to be dependent on how long the tariffs stay in place, or the on and offs of these pauses, and how all that shakes out. But what we've tried to do is take an initial pass here at a range of outcomes. It's
Hmm.
really hard to kind of do a best case, worst case type of scenario, but we recognize the high uncertainty here. So we've placed some ranges around these potential impacts for everybody to digest. The first line item you'll see there on the top right-hand side of the page is the impact on overall economic growth. And you'll see that coming into this year, we were expecting the US economy to grow about 2 to 2.5%. And with the drag from the escalation in the tariff situation, we expect that to more or less get cut in half, or maybe a little bit more. So the economy most likely grows probably somewhere around 1% for this year, or maybe a little higher. Again, assuming that these tariffs stay in place probably over the next couple of quarters or so. From a corporate profit growth perspective, there's no doubt that this will eat into margins. Companies are going to have some higher input costs by way of the higher costs from any items that are subject to these tariffs. And there'll be potentially some revenue hits as consumers may choose to take a pause on some of their spending with so much uncertainty going on. So rather than growing at the 10 to 14% range that we had been expecting at the beginning of this year, we think profits probably grow more like in the 6 to 8% range.
I see.
I want to pause here to just emphasize for those two items. Those forecasts do represent a slowdown, but importantly, the most likely outcome, we think, is still positive growth for the economy and for profits. While the
So,
probability of
Russ, does that
recession
mean like
is,
one of the common questions that we're getting is, are we about to be thrown into recession? And so, I mean, a very legitimate fear when you see all of the disturbance happening to kind of up, at least in the last little while, pretty stable structures, seemingly. Um, is all of this just throwing everything into turmoil and about to throw us into recession? What would this perspective say about that question?
yeah, so again, emphasizing the most likely outcome being positive growth. And while that probability of recession has increased slightly, we still think that that is the less likely outcome overall.
Hmm.
We think growth here being around 1%, that's a slowdown, that's a headwind. People are going to feel that, but that's not an environment where the economy is actually contracting or going into recession.
Hmm.
So it's that middle ground of acknowledging the headwinds without the scenario that maybe some of the doom and gloom headlines would suggest that the economy is going to go into a full-blown collapse. We just feel very strongly that that's not the case.
What's interesting about that too is a common follow-up question that we get is, well, if we're not headed toward a recession or some kind of significant collapse, why would the market react the way that it has? I mean, we have kind of a framework for that, but why? What's your perspective there? Why, if this doesn't seem like we're marching toward a recession, even though it's possible, why would the market react so heavily?
Yeah. Well, behind market behavior is human behavior. And as we'll talk about here a little bit later in the update with some of the slides we've got, as humans, we're hardwired to not like change or uncertainty. And anytime you see major changes to the rules of the game, whether it be trade policy or tax policy or regulatory policy or otherwise, that often manifests in the form of market volatility. And there's no getting around it. What was proposed here on April 2nd and the changes to the trade policy that are being discussed, they are massive. And so the market volatility represents the magnitude of those changes and the adjustment that market participants are trying to price in and to find what that new fair value is on a go forward basis. The other reason, Josh, is
Makes
just
sense.
simply the fact that it's changing so rapidly
Yeah.
from day to day, or right, and that will show up in the form of more violent swings as well.
Yeah, and yeah, like you said, we'll get to this in a minute, but more than anything, like good news, whether it's good news or bad news, the market just doesn't. The market reacts to surprises. So if market, generally speaking, seemed to think A was going to happen, and it comes out that B is actually going to happen, then you'll see a big swing up when the tariffs were paused, massive down when the tariffs were like much more expansive than most people thought, even though those were on the table. So it was surprise that caused massive swing down, massive rebound. And so it's while we of course might say, well, historically speaking, when you zoom out far enough, it all shakes out. In the short term, the rapidly changing policy, we should expect volatility, and that's going to be uncomfortable.
That's exactly right.
Yeah.
Yeah, it's a very normal part of market behavior. These surprises happen on a daily basis, but they're on a
Hmm.
much more micro level, like maybe a specific company with an earnings announcement,
Right.
or maybe it's a jobs number that was 10 or 20,000 off of what economists were
Hmm.
forecasting, or things of that nature. And we kind of write that off as just normal, noise.
Yeah.
These are just more pronounced because of the magnitude of the movement, and of course, the media coverage and the fact that we all have a computer in our pocket and
Yeah.
are much more real time informed than ever before. We feel the emotions more strongly about something
Mhm.
like this.
So what might the impact be to the Federal Reserve's expected actions this year? On the kind of constant docket for the last couple of years has been inflation and interest rates. How does this change that perspective, if at all?
Sure, yeah. So the Federal Reserve started lowering interest rates last year, made progress by about 1% in the back half of the year. And then they put themselves on a pause because they've seen that the labor market is healthy and they wanted to get further information that inflation was continuing to move down. We did just get the reading for March that the consumer price index came in at 2.4%,
Hmm,
which was an unexpectedly positive development, meaning that inflation number went down by more than people were expecting. Another one of those little micro surprises that we
sure.
see on a regular basis. But on a go forward here now, the Federal Reserve has made very clear that they're also in a wait and see approach about how these tariffs may play out. And they're in a
Mhm.
little bit of a tough spot because, on the one hand, the expectation might be that tariffs could cause inflation in the near term, and the Fed would be hesitant to continue lowering interest rates in an environment where inflation was going up. And you can see that forecast on the right hand side of the page in the middle there. The expectation that, yeah, in the near term, we could see inflation go to 3.5 or 4%. But on the other hand, if the tariffs do take a bite out of economic activity, that may cause companies to stop hiring as much as they are, or in a more dramatic scenario, actually start laying workers off.
Mhm.
And a deterioration of the labor market like that would be a signal for the Fed to start lowering interest rates. And so there's a little bit of a tug of war that they may see here, depending on how that inflation and labor market dynamic plays out in the coming quarters.
Yeah, it does seem like a theme that folks are hearing regularly is who knows a little bit, right? And
It's
but
okay to say you don't know. That's a part
yeah,
of investing, right? We want
yes,
certainty as
yep,
humans. Again, that's kind of back to our hard
yes.
wiring. We want to be able to see the path ahead. But I heard a great quote. Howard Marks wrote a piece, and he said, "There's no room for certainty in investing in equities."
Uh-huh.
That is why we get paid a premium to own stocks over safer assets like bonds or even holding on to cash,
Hmm.
because that uncertainty level does increase, at least in the near term. And as we'll talk about, your time horizon matters a lot as
Yeah.
far as the outcome of owning stocks. And so that's a part that we have to just be comfortable with in owning stocks and having the appropriate size or amount of stocks in our portfolio based on our needs and our emotional tolerance for the ups and downs.
It's a great transition because I think what a lot of people are probably thinking is, all right, we've just run through a lot of data, a lot of projections, a lot of expectations. What do I do with all of this information? A theme that we talk about in terms of building strategy is trying to eliminate the need to guess and be right. Why? Well, because nobody can guess and be right enough times for it to pay off. And so what we want to do is look historically and say, again, you made a great point. People naturally are hardwired to not want surprises, not want change, things like that. And that's totally justified. And so what we want to do is take that instinct and then say, what strategies actually help somebody with long-term success most probably. So let's transition a little bit to what should people be doing in moments like this?
Yeah. So I think that the first thing to do is just have a little bit of context in saying that while it's uncomfortable, it's not unusual. So if you want to move one slide forward for us here, Josh, we can see that just looking at the last 45 years of stock market behavior, the red dots on the page, these represent the biggest decline during each calendar year. So the blue bars, that's how much money you would have made as an investor in the year staying fully invested. But the red dots represent the biggest decline. So on the far left-hand side, for example, that's 1980. The stock market was up 33% in 1980.
Hmm.
But on the way to being up 33%, there was a 17% decline during the year. And what you can see just by scanning those red dots is how common it is to have price movements like what we've just seen. Now, the emotion is high, and the reason why for the volatility can be different. But this comes into the instinct that we have as humans to take action.
Mm-hmm.
And it's often that taking action, and many people think, well, I'll go to a safer investment strategy until I feel better about this. That instinct for protection, which is hardwired into us as humans, often leads us to hurt ourselves dramatically toward achieving our long-term goals. And we can maybe look at the next slide here that quantifies that a little bit. What
So
we're
yeah,
showing
this
here, yeah,
this is I think a profound analysis because okay, so what are we looking at here? You're looking at the value of $1 million invested in the U.S. stock market measured by the S&P 500 from January 2003 all the way through March of 2025. So just, couple weeks ago. Um, so walk us through a little bit of what we're looking at here. It looks like on the left side, if you just left the dollars in, you're 1 million
we
over
started
that.
with $1 million
Yeah.
there, and we were invested for that full 22-year period. At the end of the 22-year period, you'd have had a portfolio that was $9.9 million.
Mm-hmm.
And that's your classic, I'm invested, I'm letting it go, I'm not taking any action, $9.9 million. Now, if we had, let's say, gotten nervous or scared or at some time decided to get out of the market, if we had missed just the 10 best days during that 22-year period, rather than having 9.9 million, we end up with only $4.6 million at the end of the period. If we miss the best 20 days, the best 30 days,
Mm-hmm.
the best 40, you see how it's a significant impact on the overall wealth creation just by missing a small number of days in the market. Now, importantly, look at the left-hand side of the chart or of the page. Let's look at those 10 best days and when they occurred. 2008, 2009, 2020. Now, when we think about positive stock market environments, 2008, 2009, and 2020 are not the years that most people would guess
Yeah.
or that first come to mind. And what this shows us is that even during downward movements in the stock market, we often get major rebounds, similar to what we saw just earlier this week.
Yep. Yep.
And missing out on some of those days because we're trying to respond to that instinct we have for safety and security can often have major implications for our long-term wealth creation and ability to achieve our financial goals.
And this is why when you said, people have the instinct to take action, the action we want to take is well in advance. The action we want to take is building plans that align to somebody's goals. This sounds like boring, rote financial advisor talk, and it totally is. And it's because historically speaking, it's the most reliable path to success in the mid to long run. What is that? What are your goals? How far away are they? If you have a long-term goal and we had long-term strategy aligned to that goal, and we had short-term massive volatility, how do we think we would respond? And we should choose strategies based on things that match both the time frame, but then also my tolerance for risk. Uh, what that effectively does is tries to eliminate the need to guess and be right. And it's why Russ, this next slide that you sent over, I think really kind of sums things up pretty consistently. And I think the way that you put it is the more I zoom in, the more it looks like a coin flip, and the more I zoom out, the more it looks like reliable outcomes. So
Yeah,
so
that's well
give me kind
said.
of the high fly over here, and we'll land the plane here.
Sure. Well, what we've looked at here is different time horizons. And over those time horizons, what percentage of the time were stocks positive versus what percentage of the time were stocks negative. And on the left-hand side of the page, if you start with just a daily view of the markets, again, it's more or less a coin flip. 53% of the time, the daily movement is positive, and 47% of the time, the daily movement is negative. So if you're a person who is checking their stocks app on their phone on a daily basis, you're having about half of your days are good days and half of your days are bad days, and you're riding that emotional roller coaster. If we zoom out to a month, to a quarter, let's pause at the 1 year time horizon. We can see that historically here, and to be clear, this is 100 years of history. This is going back to 1928. 3 out of every 4 years in the stock market are positive. So now all of a sudden I'm feeling better about myself because I'm
Hmm.
seeing that steady upward progress. I'm feeling like I'm being rewarded for owning these investments. And as we zoom out even further to 5, 10, and of course then 20-year windows, that percentage of time that stocks provide a positive return continues to increase.
Hmm.
And so it comes back to what you just said, where some clients have been asking, well, what should I do right now? What are we doing right now to protect me? And my answer is the same every time, which is we've already done that.
Mm.
You've already done that. Through the way that the portfolio design was initially constructed based on the assets that you have, your financial plan, your needs, the purpose for the money. Why are we investing? We've already put those things in place. And these times are always good to review our risk tolerance, but we don't want our visceral emotional reaction during periods like this to drive our long-term strategy, right?
Hmm.
This is the time to have that composure and to lean on professional management to guide you through the uncertainty of market environments like this that have happened before and will happen again to ensure that you're staying on track to achieve that future vision you have for your life and the reason why you're investing in the first place.
Yeah, and it'll sound it'll sound familiar to anybody who has had a review with us. But we talk about the idea of assessing your goals, picking strategies based on risk tolerance and time horizon, and then how do we evaluate those goals, or how do we evaluate those strategies? Number one, have the goals changed? Number two, has your risk tolerance changed? And then number three, uh, if neither of those things have changed, there still might be a reason for change, and that would be, does what's happening in the market explain what's happening in your portfolio based on the design of the strategy? If not, even if it's better than expected, we might have reason to change, because if it's better than expected, it could also be worse than expected. So how those are frameworks that we're using to evaluate strategy. But you nailed it. From a planning perspective, aligning the goals, the strategies, the time frame, and then evaluating the strategies based on what's kind of our working theory of what should happen to this strategy given what's happening in the market. That would be frameworks for potential change. And then taking a look at the more that we zoom out, the reason that we're looking at short, mid, and long-term timeframes is that the reliability of success in the long run, without trying to guess and be right what's going to happen in the short term, because clearly that's as close to a coin, pretty close to a coin flip. Uh, that's the path to longer term success from a historical perspective. So it's important to acknowledge both that there is highly justified reason for feeling uncertain and feeling scared and feeling anxious. Why? Because, like you said, when you look at your phone every day, if I see 7% down, 8% up, and I see the value swinging so heavily, that should make you concerned. That should make you concerned. It makes me then want to go, oh no, are the strategies that I've selected still likely to create the outcomes that I hoped for? And then it's through discussion and analysis that we get to answer that question. And so the important part is feel, think, discuss, act. And that middle part is really where we welcome these types of conversations. We really value people like you, Russ, for your team's perspective. So I want to thank you again. Lots of valuable stuff here. I know you're running all over the place and having a lot of discussions like this. So we really value your time and your perspective. And yeah, th thank you again, and we'll look forward to our next conversation.
Appreciate you having me, Josh. Thank
Yeah.
you.